India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Will it be a better, even better day as compared to yesterday? That's the question. That's the hope. Overnight markets have bounced a little bit. I am Prashant. With me, my colleagues Nigel and Reema. Guys, hi, good morning.
Morning.
Hi, good morning. Just about 2 days left for the budget. So many earnings to track. And unfortunately, we wake up with the dreadful news about the stampede at Mahakumbh.
That's really unfortunate. I mean, numbers are still trickling in, and one just hopes that the numbers are small. I mean, and just casualties. I mean, the state government's not confirmed anything, but I think news wires, etc., are carrying about some deaths, but we'll have to just wait.
We just prayers and support to all our brothers and sisters out there. So hope things are not too bad out there and hope things are under control. But prayers and support to all those.
Absolutely, and we'll keep you abreast with what comes out of there. But that's essentially, of course, the mega sort of event, religious gathering, the Mahakumbh, which of course is underway in Uttar Pradesh. Visuals coming in from there. Okay, well, let's sort of look at the markets this morning, and it's looking better. And let me just start from the beginning. So. Last night, equities rebounded from the sharp sell-off that we had the prior day. And the sell-off was fueled by AI stocks, NVIDIA, etc. And, last night you had some of that rebounding. S&P about 1% higher by close. You had the NASDAQ, which was up about 2%. And the stocks like, the AI theme, NVIDIA up almost 10%. You had TSMC, which was up about 5% or so. So has the scare passed, I think, is the question a lot of people are asking. Has the panic subsided? And was what we saw day before yesterday a big buying opportunity? It's still not very clear. Because despite the rebound that we saw, only 3 out of 11 sectors in the S&P rose. To be fair, though, this has been, in the last 2 days, concentrated in large tech names. Yesterday morning, we were talking about how, if you looked at the prior Wall Street session, that's Monday's Wall Street session, despite the sharp sell-off on the NASDAQ, etc., only 30% of S&P companies were actually lower. And this morning, with the rebound, it's only 3 sectors which are actually higher. So, works both ways. You had the dollar index, which is up about 0.5% to 108. And I think the dollar moved in reaction to some of the tariff headlines, which are making it to the front pages once again. So Trump essentially saying that he wants, and I quote, much bigger tariffs. Who knows what that means? But this is, of course, after his Treasury Secretary, Scott Bessent, if you can move the graphics along, pushed for gradual tariffs starting at 2.5%. So, eventually the market will just wait and watch for actual action rather than just talk. But the White House press secretary also confirmed that February 1st is the deadline for potential tariffs on Canada, Mexico and China as well. Quantum, etc., will it be 10% as he earlier said? We don't know. But the dollar was bid on the back of this, 0.5%, almost close to about 108 odd out there. The other, later today, it's a big one because you've got the mega cap tech companies which will report earnings. Tesla, Microsoft, Meta will report post-US close, and Apple reports tomorrow. The reason why these earnings are especially important is because we will also get to hear from people like Mark Zuckerberg, Elon Musk and others about what they make of DeepSeek and the Chinese AI advancement, and whether they think what they've heard so far, what they've seen so far is essentially going to lead to lower capex on AI infrastructure. I think it becomes important in that context. The other one, of course, is the Fed meeting, the Fed decision tonight. No changes expected, and I don't think markets are really expecting them to learn anything new in that sense with Trump and his policies, etc., which are still to be announced, let alone take effect. Now, we are in much better shape, I think, this morning, and let's hope that things look better. So I'm just going to put some levels to circle the markets here around. Nifty, we closed yesterday. The initial resistance now is at the 20-day moving average, which is 23,375. And then we get to the 40-day exponential, which is 23,620. With what we saw yesterday, we closed around the hourly averages, the 40 hourly, etc. So you look at the dailies now, and let's hope we get to it. On the downside, lows should not break. I mean, 22,786 is the low on the Nifty. Similarly, for the Nifty Bank, we actually almost hit the 20-day moving average with the sharp rebound. The Nifty Bank, of course, was the sharp outperformer yesterday. And the 20-day is for the Nifty Bank at 49,286. Then, of course, we get to the 40-day exponential, which is 50,124. And on the downside, the recent lows will be in focus. Remember, it's looking a little better. The market here has already corrected quite a bit, so that comfort is there. That it's not like the US, which has not seen any correction. And when the correction comes, it's like what we saw on Monday. But having said that, there is still important events like tariffs. There is, of course, the Fed decision. There are these important mega tech earnings which can move, which I think are more important than what we'll hear from the Fed tonight. And, of course, then we've got the union budget as well. Expectations are not high, but these are all just event risks over the next 3 or 4 days. 45 points higher on the GIFT Nifty. Nigel.
Well, that's right. And overnight, NVIDIA, they lost in the previous trading session $600 billion of market cap loss. And yesterday put on $255 billion, which is the third highest by any company in the history. So that was an important point. Let's focus on the cues, though, that we have. Remember, we have the expiry that will play out tomorrow itself. That's the monthly expiry. And yesterday's trading session, if you look at the FI data in the cash market, they sold in cash, but they added stock futures. There's a reverse arbitrage that's taking place out there. It has an element of rollovers as well that's taking place out there. Now, you're looking at the FI net short numbers and you'll say, whoa, those net short positions have come down by close to around 1 lakh contracts, because a few sessions ago, it was at around 3.5 lakh contracts. And now, in fact, it's at around 2.36 lakh contracts. But as we explained yesterday as well, for the next series, the lot size has changed. So effectively, the Nifty futures lot size for January is around 25. And the next series, that's in February, it goes to around 75. So that explains why there could be a bit of a short covering bounce that played out, but it also could be attributed to the change in lot size. So just keep that in mind, that big short covering bounce is yet to take place if you're due for that. The long positioning is at around 25%. It's come down, it's gone up from around that 16% or thereabouts, and shorts are holding around 75%. Now, you're looking at the most important strike, and you want this level to hold out. That's a 23,000 put. Yesterday, it added close to around 50 lakh shares out there. The premium was roughly around 150 to around 200 rupees. So that's giving you the crucial support zone. You don't want the 22,800, 22,850 odd mark to break on the downside. That's going to be very, very important. And on the upside, you'll get more confident once we go to around 23,200. In fact, you'd like to look at yesterday's high as well as yesterday's low. And from a bullish perspective, you'll want to get past yesterday's high, which is at around the 23,137. Important mark to track out there. And on the downside, you don't want the 22,800 mark to, get broken. I'm just pulling up a graph now of the Nifty Bank. It did very, very well yesterday, but it came off the highs of the day and it went very, very close to testing that 20 DMA. So you'll want to get back closer to around that 20 DMA, which is the crucial resistance zone. A few stocks I'll be tracking. Well, I'm looking at some of those stocks that have come out of the F&O ban. The list comes up for you on the screen, so keep an eye out on a few of these names. Sometimes we do see some action. And just one more point. A lot of stocks in the broader markets, they are falling. But keep in mind, some of this is trading related, not fundamental related. So there are plenty of stocks actually that have come out there to levels that you like to nibble in there. Don't throw in the towel. This is an opportunity, for those stocks that have not gone up on froth and on exuberance. Reema, what else are you tracking?
Well, the DIIs are betting on the market. So in terms of the numbers, yesterday, the DIIs pumped in 6,800 crore rupees, while the FIs sold 4,900 crore rupees. So far in the month of January, this is how the numbers stack up. The FIs have sold 79,000 crore rupees. DIIs have matched it by buying a little more than 80,000 crore rupees. But for the FIs, January marks the fourth consecutive month of big selling. From the month of October, that's October, November and December, Jan, the FIs have sold nearly 2.5 lakh crore in the cash market. Asian markets continue to remain shut today, most of them at least. China, Hong Kong, Singapore, Taiwan, South Korea on account of the Lunar New Year. And in terms of events to watch today, of course, the Fed meeting, the first one, since the Trump inauguration, Trump took over. So it's going to be crucial. But these are the big earnings. Tata Motors, Bajaj Finance, Maruti, Ambuja Cement, Blue Star, Voltas would be some of the big ones to track today. And ITC Hotels listing. So watch for ITC Hotels and ITC. The price discovered for ITC Hotels was 260 rupees. So And we'll get to the earnings reaction in our top 10 segment. But let's get to the equity calls then. Mahesh Nandarkar of Jefferies says their meetings with 60-plus investors in Asia and US highlights concerns on growth outlook, rupee and government capex. He says their cautious view on the budget is predicated on an expected slowdown in government capex, with stock corrections largely build in those worries. He says potentially no negative surprises on tax can be a relief. He believes the Feb 7th commentary by the new RBI governor would be an even more important event and likely signal a pro-growth stance, and he would look to add more risk ahead of 7th of Feb.
Okay, all right. Vivek Paul is now joining us, Head of Portfolio Research at BlackRock Investment Institute. He's joining us now from our studios here. Vivek, great to have you with us here. Thank you very much for your time. Appreciate it. Let's just, of course, start with this entire AI-led sell-off and the rebound that we had last night. What do you make of it? You think, do we know enough now? I think people are just scrambling and figuring out whether this is really going to disrupt all this AI spending in the US on the back of which stocks have been doing well, or not really. What's your sense?
Well, look, firstly, thank you for having me on. Great to be here. I think in periods like this, when there's just enormous market reactions and lots of speculation, we've really got to examine what do we really know? What do we actually know? And I think what we've learned is that it appears that the deep-sea kind of technology has made some material advancements in efficiency. Right? So it appears that there are some of those techniques that kind of can save something in the order of 97% of the training costs relative to the legacy approaches. That is a big deal. So full stop, we know that. The implications of that, if we zoom out, there has to be something that accelerates the AI transformation more broadly. So we've been talking about this idea that this AI transformation is going to change markets. It's one of the structural megaforces that does that. And a way of looking at this is imagine if all of those legacy chips got 10 times more efficient. I mean, this is a big deal. What this means, I think, is that effectively we are going to have greater adoption. We're going to see more of those next phase winners come early, and I think that has to be the overall reaction. Now, that wasn't what markets appeared to react to immediately on the Monday. I think the point there was the market seemed to be reacting to the idea that perhaps as a result of the greater efficiency, some of the legacy infrastructure build out in the space was perhaps wasted money. I think it's way too early to make that call. I think if we were at a steady state adoption already of AI, then maybe the idea of greater efficiency
so you're
might
saying
be...
we're early in the cycle, so there are lots of use cases, and so I mean it's not... we can't conclude right now, right away.
Exactly. I don't think it's a cyclical
So we won't
dynamic.
see tech companies, and they all report tonight. We won't see them scale back any of the capex, etc.
Well, I think the point here will be it's going to be crucial to understand the kind of the commentary they give around those numbers, right? How are they going to react to this? And I don't think we can kind of sort of expect one thing or another right now. My point would be that in terms of the broader AI megaforce that we're talking about, this has to be an accelerator.
But will this be the pin that, in a way bursts the bubble? And coming on the tariff threat, right? We keep hearing headlines coming out of Trump, including yesterday. So what's your view on that?
Okay, well, I think on the first point, pin the burst bubble, that's not our expectation for the reasons I mentioned. Indeed, you see the reaction in the US markets yesterday, a large kind of unwind of some of the stuff that happened the day before. Moving to tariffs, I mean, in some ways we're making the same point that we need to really sort of sort through what do we know relative to the noise. And I think here, what do we know? We know that if the tariffs are comparatively targeted in certain ways, that's got a much less broader economic impact than if they are broad brush. And we're still going to be learning exactly what's going to be the case. And I think the starting point here would be that, there's a lot in the price already to some degree. We've talked about, I think you talked about earlier on the show, the idea of sort of some trouble, outflows from foreign investors with regards to Indian stocks. So some of that's in the price already. And I think, again, we still don't know exactly what's going to occur. The broader point, I think, on tariffs, I think, again, if we zoom out and look at the bigger global picture, macro policy is much more uncertain now than for a generation. And I think that is really impactful in terms of sort of volatility we're likely to see. For a generation, we saw macro policy effectively dampen volatility. It kind of acted counter-cyclically. I don't think that's the case now. The election of the US president, and it's not just the US president, more broadly, you've seen incumbents everywhere get a bloody nose from the idea of changing of the guard or a surprise in election results. There's mandates for change, which means that macro policy more broadly can add to volatility going forward.
All right, Vivek, good to have you in the studio. Tell us, where does India come in the scheme of things? You know, till a long time back, we were talking about India standing out from the emerging market basket. Growth is there, earnings is there. Suddenly, that narrative seems to have, taken a turn. What's your view on India post the recent correction, and also given the kind of selling we have had from the FIIs?
Yeah, so I think it's really important to kind of distinguish between the cyclical and the structural when it comes to India. There are cyclical dynamics that we've talked about here that I think, the idea of the kind of growth slowing down, etc., you can understand to some degree the tariff uncertainty, why there has been some of that outflow. But the structural picture remains strong. And, to give you the kind of the bottom line here, when we're building longer run portfolios, we'd advocate an above benchmark weight, particularly given some of the correction that we've seen. The demographics megaforce that's transforming the economy, that's a huge advantage for India relative to many other countries, right? The idea that the working age population in this country will increase relative to almost everywhere else where it's going to decrease. And so I think when we're looking ahead, we've got to distinguish between the cyclical and the structural. The structural, I think, remains strong. So anyone with a longer holding period, these are the sort of times to kind of get involved.
All right, and we haven't spoken about this for a while, but India versus China, the Chinese market is very, very, very cheap. Suddenly they're making signs that maybe their economy will come out of the trough that we've seen. Between India and China, which side would you lean to?
Well, again, I think the nature of the uncertainty around tariffs, etc., is going to be hard, right? I mean, the point we've been making for a long period of time is this is an environment whereby there's sort of greater geopolitical sort of dispersion, and in that environment, so where the US is pulling in one direction, China's pulling one direction, the opportunities for a country like India seem pretty sizable given the points I just made around demographics as well. So I think there is a case here that, from today, what we're talking about in terms of structural opportunities, we're talking more about the Indian structural opportunities than the Chinese now.
Super.
Right, Vivek, we'll leave it there. Thank you very much for joining us,
Thank
and
you.
hope this is the first of many chats, many conversations.
Thank you so much.
Thank you. Well, that's Vivek at BlackRock Investment Institute with his perspective on markets and some of the most important hot button issues out there. We'll take a quick commercial break here, but before that, let me just quickly tell you what we're going to be doing over the next 2.5 hours or so. So 8:35 in the morning, you'll hear from Pralay Mondal of CSB Bank, and he's going to be joining us on the third quarter earnings. 9 o'clock, you'll be hearing from the management of Hindustan Zinc, third quarter again. 9:15, of course, is the market master of the day, market conversation. 9:30, Bajaj Auto will be with us with their third quarter numbers. And CG Powers are going to be a company we'll speak with. Outlook, extremely important. Stocks corrected quite a bit. At 9:50, Suzlon, again, a company which is, at least a stock which has lost a fair bit recently. We'll talk about their outlook post third quarter. 10 o'clock, we'll have budget expectations and, of course, what the RBI, etc., has been doing. It's the economy, the budget special at 10:15. Lata speaks with KB Kachru of Hotels Association of India and Vijay Diwan of APJ Surendra Park Hotels on the hotel industry's asks from the union budget on Saturday.
Well, we're slipping into a small break. We come back, we'll focus on all the stocks that we've lined up for you in our special Top 10 segment. We're looking at Bajaj Auto, Mahanagar Gas, GMR Airports, Suzlon, BHL, all of them will be reacting to positive news flow. While on the flip side, we'll have a few stocks that will be reacting to negative news flow. JSW Energy, SBI Cards, Mahindra & Mahindra Financial, Colgate, as well as Star Health. Slip into that break, come back, we'll get into further detail on all of these names.
Good morning. The GIFT Nifty is suggesting that the relief rally that we had yesterday is likely to persist and continue. So 50 points up right now on the GIFT Nifty. The question is, can we conquer yesterday's intraday high of 23,137 and then hit higher towards resistance levels of 23,300? That would be the key to track. But for now, let's get to individual stocks. Our research team is standing by with our list of the top stocks for the day. Good morning, boys. So let's start with Sudarshan on Bajaj Auto.
Good morning, Rima. So it's a margin-led beat like TVS Motor Bajaj Auto has also reported a healthy set of earnings and margin has come in at 20.2%. There was an expectation that margin may slip below 20%, but it's above 20% for 6 straight quarters. And some of the positive factors that have worked for the company: first, demand remains healthy in 125cc plus segment. Raw material cost seems to have stabilized. Second, favorable currency environment also has helped margin. And third, despite the EV expansion that companies has been taking, it continues to maintain the market share in the ICE segment as well. But there are some of the negative factors as well. First, KTM exports were lower because KTM has been facing certain issues overseas. Third, demand remains a concern in the entry-level segment. Nigeria demand has been steady. Company continues to do the selling of 35,000 units per month, but it's much below the peak level that company had seen. And pricing concerns both in the EV segment. Company has taken certain price reductions in certain areas like UP and Bihar. On the numbers front, EBITDA has increased by 6%. Margin remains flat YOY. It has come at 20.2% versus 20.1%. Outlook is healthy. Company expects exports to grow by more than 20%. Domestic motorcycle growth that was at 6% as of H1 FY25. Company says it's likely to see a growth in the range of 6 to 8%. And that growth range would be for the industry. So on the earnings front, it's a steady set of earnings and outlook is healthy as well for Bajaj Auto.
I believe the EV business has also turned EBITDA positive in Q3, aided to some extent by the PLI benefits. We have the management joining in at 9:30 a.m. to discuss the Q3 numbers. But over now to Vivek for JSW Energy. Vivek.
Well, good morning. That's right. So JSW Energy, muted said as far as Q3 was concerned, but one thing to note is that the company has, or the stock has seen a very sharp sell-off, so that may limit the downside, but overall a muted quarter as far as JSW is concerned. Revenue is down by almost 5.5% on a year-on-year basis. EBITDA down almost 17.5%. This on the back of the fact that the company that has a significant portion of its energy capacity that it sells on the merchant market or which is not tied through long-term PPAs actually witnessed some amount of compression as far as spreads was concerned, given the fact that DAM, that is the day-ahead market prices or the spot prices, were down almost 26% on a year-on-year basis. This impacted the company's margins as well as the spreads. On the back of that, margins this time around 38% and profitability down almost 32% on a year-on-year basis. Company is looking to raise close to 3,000 crore via an NCD issue. And also remember, the company actually saw its wind capacity start, but this is a seasonally weak quarter as far as wind energy was concerned, and that also impacted the earnings. What is it that we need to watch out for? The first thing, remember, there was a significant sell-off in the stock price. This is after CERC rejected the company's BESS project, battery energy storage project tariffs. And now the company has gone ahead and appealed this particular tariff order that was passed by CERC, and this particular hearing at APTEL is scheduled on Feb 6th. That's an important trigger as far as JSW Energy is concerned. Expect some pressure on the stock today.
Okay, all right, some pressure on JSW Energy. Thanks for that, Vivek. Let's go back to Sudarshan. Sudarshan, tell us about MGL.
So like IGL, MGL has also reported earnings that are better than estimated. It's a volume-led beat. Volumes are up 2% sequentially, and on YOY, it's up 12% year-on-year. EBITDA is down 21% sequentially, but it's much higher than our estimate of 285 crore. It has come in at 314 crore. Margin also has come in almost at 18% against our estimate of 16.3%. Volumes have come in at 4.12 MMSCMD versus our estimate of 4.07. And EBITDA per SCM, that is one of the important parameters, it has come in at rupees 8.30 versus our poll of 7.40. But beyond the earnings, what would be in the focus? What does company say on the pricing front if company is planning to take any price hike? And second, what is the update on the APM gas allocation if company has got certain assurance from the government? But I'm going with green because of the earnings.
Okay, all right. So thank you very much for that. Well, we have GMR Airports, which should be in focus, and Suzlon on the back of earnings as well. Vivek has got both. Vivek, morning.
Well, good morning. Much better results both from GMR as well as Suzlon. So first, let's start off with GMR Airports. Revenues high by almost 19%, largely led by higher aircraft as well as higher passenger growth in the quarter gone by. EBITDA high by almost 48%, margins coming in at 37.4%, a strong expansion as far as margins were concerned. profitability at 202 crore versus a loss seen last time around. But remember, there is a one-time 410 crore impact as far as profitability is concerned. This is a positive impact that the company has recognized. This is on account of disposal of stake in the Cebu airport. Also remember an important development, Hyderabad airport has actually announced a dividend for the first time since 2019. One worry is the fact that net debt has actually inched up on a year-on-year basis, up 17%, but overall a strong set of from GMR airports. On the other hand, Suzlon, remember the company had guided for a much better H2 in terms of execution, and the company has delivered. Revenues higher by 91%. This was aided by net volumes or net execution coming in at 447 megawatt versus just around 170 megawatt on a year-on-year basis. EBITDA has doubled on a year-on-year basis, close to 500 crore. Margins at 16.8%. Profitability higher by 91%. Order book continues to remain very strong at 5.5 gigawatt. Now both CNI as well as PNU actually contribute close to 80% of the total order book. Company has also mentioned that they look and evaluate further inorganic growth opportunities.
Thank you very much for that. And at 9:50 a.m. today, we'll have the top management, the CFO of the company, joining in to detail the way forward. But it's back to Abhishek now for SBI Cards and M&M Financial.
Well, to begin with SBI Card, it's like Maruti ad, credit cost woes doesn't seem to get over. So 14-quarter high credit cost of 9.4% versus 9% in the previous quarter. For 24 quarters in a row, their annualized credit cost on a quarterly basis has been north of 4.5%. The net interest margin continued to remain on the lower side. It was at 10.6%, which is perhaps one of the lowest that you are seeing in last 19 quarters. Revolver rate has improved this time around to 24% versus 23% in the previous quarter. However, the return ratios, that is ROA, is at multi-quarter low of 2.4% versus 2.7% in the previous quarter. The PAT has declined by more than 30% YOY and more than 5% sequentially, and much below many analyst estimate like Motilal Oswal and Nuvama as well. M&M Finance, the loan growth has come in at 19.5% YOY and a decline of 0.7% sequentially. So YOY, the loan growth is one of the lowest that you are seeing in last 10 quarters. The gross NPA ratio is the highest in last 4 quarters, coming at 3.93%. Net NPA ratio is, the highest in last 8 quarters. Now, it's weird to see that net NPA has increased massively given the fact that they have reduced their PCR. So, provision coverage ratio is at 50% versus 59.5% in the previous quarter. It's one of the lowest that you are seeing in last 18 quarters, and this has aided the bottom line. Housing finance subsidiary has reported a net loss this time around of 27 crores as asset quality woes have weighed in over there. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Vamakshi. She's here to tell us about BHEL. Hi, Vamakshi. Morning.
Well, good morning, Nigel. When we look at BHEL's numbers, revenue saw an uptick of nearly 32% on a year-on-year basis. This was 4% higher than what the street was penciling in, and this growth was supported by both of their segments, power as well as industry. The gross margins for the company also rose by 1,021 basis points to 37% odd. When we look at the EBITDA margin, that is seeing an improvement of only 25 basis points year-on-year. This has come in nearly 126 basis points below the consensus estimates. EBITDA too seeing an uptick of 41%, but again, there's a miss out here as compared to consensus estimates. Why this miss? And that is because the other expenses saw a substantial jump this time around. The net profit, despite that, nearly tripled, but again, came in below the street's expectations. Overall, the order inflow was quite robust. Order inflow came in at 6,860 crore. This is an uptick of almost 167% on a year-on-year basis. The order book is also looking quite healthy at 1.6 lakh crore. This is an uptick of nearly 47% on a year-on-year basis. When we look at the segment-wise performance as well, that also seems quite healthy. Revenue saw an uptick of 32% for the power segment. EBIT margin also improved by 178 basis points. As far as the industry segment is concerned, the revenue saw an uptick of 33%, and the margins here have improved substantially by 465 basis points to 6.4%. So overall, when we look at the numbers, yes, it's a miss on EBITDA as well as the margin and the net profitability, but that is mainly on account of other expenses. But apart from that, the rest of the results look fine. So my sense is the stock is expected to open higher.
Okay, all right. Thanks a lot for that, Vamakshi. Well, hopping across to Mangalam now. Mangalam, Colgate, not too good?
Well, a feeble set in what is a tough business environment. We've seen that across a lot of the FMCG companies, and Colgate no different as well. The revenues just shy of 1,465 odd crores. The street was working with a number of below 1,500 crores. The EBITDA, as a result of which, was a bigger miss, 454 crores versus expectations of around 475 crores, and the net profit came in at 323 crores versus expectations of 337 crores as well. Even if you look at it year on year, it's just a sub 5% revenue growth, in which the domestic business has actually grown just about 3% odd. We've seen a decline in both the gross margins and the EBITDA margins, the net profit as a result of which has declined by about 2% too. Though not all is bad, what's good is that the company's reported mid-single digit volume growth. That was pretty much in line with what the street was expecting, and there has been positive momentum in the premium portfolio. Though the environment is tough, the company's called out relatively soft demand, particularly in the urban market, and they've also called out heightened competitive landscape. So that's something we'll have to keep an eye out on from a margin standpoint going forward as well. But how much of that is in the price? The stock's down about 30% from the highs, trading at around 45 times, slightly below historic valuations. So opens in the red, but could there be buying at lower levels is something that we'll track.
All right, Mangalam, thank you very much for that. So that's Colgate there. We've got some news coming in at the bottom of the screen. Let me just sort of run through the top 10, then we'll address this at the bottom of the screen. Star Health reported earnings. Yash has got details here. Yash, morning.
Morning, Prashant. So, of course, a weak set as far as Star Health Insurance is concerned for the third quarter. The net premium earned, that's grown at a decent number of about 15%, coming in at about 3,800 crore rupees. But the operational performance has been very weak. Underwriting loss, that has gone to about 49 crore. This compares to an underwriting profit of about 114 crore a year ago in the same quarter. Operating profit, that has come down by about 46%, coming in at about 153 crore rupees. PAT, as a result of which, has also seen a decline of about 26%. Combined ratio, importantly, that has seen a significant correction of about 546 basis points at about 103.28% versus 97.82%. What have been the two reasons for this? The increase in commissions and total expenses. Commissions have increased by about 43%, total expenses increasing by about 21%.
Thank you very much for that. Some more details from the NetWeb press release. One, remember the stock was down 10% yesterday. It's fallen more than 50% from its recent 52-week high, and the street was concerned because NetWeb has a tie-up with NVIDIA where they supply some of the solutions for NVIDIA's GPUs, etc. They use it. So therefore, the street was concerned. And the second reason is the 1.5-year IPO lock-in ended on Monday. This Monday. So there were additional 1 crore shares which were released, and that added to the supply pressure when there was so much negative news flow. So here the company is basically trying to say is that DeepSeek paves the way for the market to expand. So earlier, perhaps there would have been companies which were hesitant to adopt technology because of the high cost of adoption. But now with DeepSeek lowering the entry barriers, reducing the cost, we will see more customers adopting to it, and NetWeb solutions are GPU neutral, which means that they can cater to all companies, whether it's NVIDIA or DeepSeek. So that's the basic crux of it. They go on to say that the company's financials are very robust. In the first 9 months of the year, the company's revenue growth has been in excess of 60%. Their order book stands at 360 crore rupees. Their L1 pipeline is strong. And therefore trying to allay some concerns, but basically, making the point that, these developments, these breakthroughs in AI will only expand the market further, which will benefit NetWeb. A quick recap then of the top stocks to watch. Stocks with positive news flow are Bajaj Auto, MGL, GMR Airports, Suzlon, BHEL. Stocks with negative news flow are JSW Energy, SBI Cards, M&M Financial, Colgate Palmolive, and Star Health. And from stocks, it's over to Manisha now for a complete roundup of all the action from the commodity market overnight.
Thank you for that, Reema. Well, I'll start with the crude oil prices, where we have seen a percentage point of gains in the overnight market. This is after 8 days of constant decline. Well, U.S. planning to issue tariffs on Canada and Mexico imports this week is what really seems to be supporting markets, because that would mean higher prices. And apart from that, Libya protests have also prevented crude oil That supply disruption premium also is getting in prices. But apart from crude, when you look at metals, this is a very interesting trend because base metal prices have gained in US and have declined on London Metal Exchange. With the import threats and import tariffs on metals like copper, aluminum, etc., there's a lot of buying that is happening in US ahead of these tariffs being imposed. So you have copper premium in US standing at a tall $300 a ton right now, and that's exactly what we've seen in aluminum and zinc, and in some sense steel as well. So metals in US are expensive than metals anywhere in the world at this point in time.
Okay, all right. Manisha, thank you very much for that. So that's commodities in focus as always with Manisha. We'll take a quick commercial break here. You'll hear from Pralay Mondal of CSB Bank as we discuss their third quarter numbers and outlook going forward. Stay tuned, that's coming up.
Welcome back. You're tuned into Bazaar Morning Call. As promised, let's get straight to the first management. We have CSB Bank. They reported a decent set of numbers. The deposits came in healthy. The NIMs fell sharply. To understand what's the way ahead, Mr. Mondal, the MD and CEO at CSB Bank, joins us on the show. Hi, Mr. Mondal. Good morning and always good to see you win. Give us a couple of details. Your cost of funds, I think, were hovering around 7%. Your NIMs have seen some kind of contraction. What's the outlook on both these two parameters going ahead?
Good morning, Nigel, and good morning to your viewers. We had a decent quarter, as you said rightly. Having said that, there has been a little bit of a challenge in the NIM, primarily because of two reasons. One is we had taken a conscious call to reduce or degrow our high-yielding businesses like MFI, personal loans, agri, those kind of businesses, which effectively meant that we are mostly focused on our wholesale, retail, MSME, and gold. The second part is also on the wholesale side, as I said before, that we are exiting some of the larger but high-yielding relationships, which we did last quarter. And that's one of the reasons why our wholesale business is looking little muted, though we have grown there on the core book by 30%, but we have shown a 4% growth because of some of the exits we did. And thirdly, of course, the cost of funds, which everybody is facing in the industry right now, has gone up. And will continue for a while till the liquidity issue is sorted out. So I think broadly, based on all these, there had been a little bit of a pressure on the NIMs. I'm not expecting it to really pressure to calm down. So we have to wait and watch how this quarter plays out. On our cost of funds, I think it's also a function of cost of deposits, CASA, and some of the FCI borrowings, which we took to ensure our LCR ratios are much better. We ended the quarter 130% on a period-end basis and average 119% on the LCR side. So FCI borrowing would have taken up the cost slightly more than what it was normal, but with SOFR, because it's SOFR linked, it will start coming down once the SOFR starts coming down. So broadly, we are okay because overall ROA we have managed at 1.52%. And broadly, I think we are chugging along well in our overall plans, what we plan for SBS 2030.
But sir, you're guiding that in Q4, NIMs decline even further compared to Q3 levels? And what percentage of your book comes from those high-yielding assets, like credit cards and MFIs? And what's the extent of pruning of the portfolio and how much more to go?
So currently, Rima, good morning. Currently, we have around 4%, well, less than 5%, actually 4.2% of our book is unsecured, which would include some of these products and businesses which you're talking of. So we have pruned it quite a bit. And we are not growing them anymore. So we have only 3 businesses we have degrown this quarter, which are these products. And going ahead, yes, I think our NIM, we have to wait and watch this quarter, depending on how the cost of funds is and how the cost of deposits are going up. In my last interview, when I said 7% is our cost of funds, I said incremental cost of funds is around 7%. Overall, our cost of funds is closer to 6.4%. Having said that, we expect the pressure to be on, though RBI is taking a lot of steps to ensure there is more liquidity in the markets. But we have to wait and watch how it works out. But I'm not expecting NIM to go up from here anymore. We have to manage within the, I think now the range will be between 4 to 4.2. In that range, you have to play.
All right, Mr. Mondal, what about asset quality? You know, if you could give us some numbers, slippages, how you see the book shape up going ahead. Because the fear is that, you know, not just for your bank, for the industry and the whole, there could be signs of pain. What's your take?
Yeah, Nigel, I mean, fortunately for us, we saw some of this coming. I think it's a small cycle, not a big one, but still we are a small bank, so we have to be careful. So on the MFI, personal loans, unsecured loans, agri, all these businesses, we actually have degrown this quarter product by product. Even last quarter, we had degrown. So from that perspective, it's only 4% of our book at this point of time. Overall, our GNP has come down by around 10 basis points. And NNP has come down by 5 basis points compared to what it was last quarter. But on a year-on basis, there is a slight elevation. But overall, I think with a credit cost of below 20 basis points, we are pretty much okay. And I am not seeing any reasons why our credit cost should go up in this year. So I think we're pretty much safe and doing whatever we can do in terms of quality of book. And that's the reason we actually exited a lot of relationships with higher yields. And we are playing in the range between 8% to 12% range in terms of IRR for all our businesses, including gold and wholesale and SME and retail. So I think our credit quality is pretty good at this point of time.
Your gross NPAs were at 1.58%. Do you think you can bring it down to 1.5% as exit gross NPAs? And these advances, deposits growth of 25-30%, is that sustainable in Q4 or at least the first half of FY26?
I think on the growth side, we should not have too much of an issue. I mean, my guidance had been that we will grow 30% to 50% faster than the system. That has been my consistent guidance over the last 2-3 years. This quarter, we have done a little better. We have grown faster than the system by almost 100%. And I think that's because the system slowed down. We continue to do whatever we are doing, maybe a little better. But overall, I think we should be able to maintain this kind of a growth for us in the next quarter or in foreseeable future. I don't see a problem. And in terms of credit cost, I see it retaining at these levels. But slightly in the long run, we may come down also on the GNP and NNP because we had a slippage at the beginning of this year, which will carry through this year. And once we start provisioning them fully, hopefully the overall NPA will start showing little decline. But that's somewhere will happen in the next year. At this point of time, I would hold on to these numbers where we are right now.
All right, Pralay, good to speak with you. Thank you very much for joining us as always here on CNBC-TV18. And we'll, of course, come back and circle around, speak with you more over the next couple of months. We'll take a quick commercial break here. We're going to come back and we connect with Devin Choksi of DR Choksi FinServ. Some fundamental stock conversation coming up.
Welcome back. Let's invite Devin Choksi on the show now. Devin, good morning. We've had so many earnings to react to, parse through, whether it's MGL, SBI Cards, Bajaj Auto, BHEL, Suzlon. Tell us, which one is the pick of the earnings season from at least what we heard in the last 12 hours?
Yeah, good morning, Dimas. Well, I think the Bajaj Auto numbers, as you mentioned, I think they are largely in line with expectations. Particularly, I think the growth is on a higher side. More importantly, I think the larger part of the undertone of the management commentary about exports growing at 20% rate of growth, EV business contributing to the overall profits now. And on the whole, I think the business segment, I think above 125cc, is also showing higher promise for growth. So if one looks at, I think the future prospects going forward, I think each and every portfolio, be it flex fuel motorcycles, be it an electric vehicle segment, or for that matter, I think the higher amount of exports and the credit business which they have started, all put together, I think the growth looks, I think, quite promising for Bajaj Auto. In my viewpoint, I think this one company deserves to get further rated now, and probably I think one should see, I think, a consistently better performance, I think, from the commentary that we have heard from the company.
Got that. Devin, good morning. Just wanted your thoughts on CG Power, if you have a view. Numbers came yesterday, and you'll be hearing the management later after 9:30, but Your thoughts, stocks again, it's one of those names that just corrected sharply from 800 levels, has come off about 30%.
Yeah, Prashant, good morning. I think yes, on the face of it, I think I have studied the numbers, not gone into detail because of the want of time. But I think on the face of it, I think it remains a little bit disappointing set of numbers. Of course, I think we wouldn't like to make any comment at this point of time till the time we hear the management and come back again on the subject.
Okay, all right. Got that. So that is CG Power in focus in that sense. Let's just quickly take a look at a few other sort of areas as well, which have been kind of hit hard over the last couple of days and weeks now. And banking and financial services, there was, of course, CSB Bank, who we spoke with. But what's the view now, Devin? Anything looking particularly attractive? I was just looking at some of the valuations yesterday evening, and except ICICI Bank, Chola Finance, and Shriram Finance, all, I mean, I think a majority of the well-tracked financial names, both banks and NBFCs, are now below their 5, 10, 15-year, 20-year averages, 1 year forward, price-to-book multiples. Anything looks attractive? I guess they have been there or below for a while, but I think they're in focus again after what the RBI has done, and it's kind of raising questions whether we're at a turning point. Your thoughts, Devan?
Yeah, Prashant, I think the good part is I think most of the banks have and the NBFCs have been producing better results than before. So that is a good part. In spite of, I think, the challenging environment in which they are operating, still, I think the performance seems to be, I think, far better than what market was fearing about. Look at the consumer finance businesses, look at the housing finance businesses of the large NBFCs like Bazaar. Look at, I think, the growth coming in from the corporate banks, including likes of Kotak's. I believe that I think the business condition remains absolutely conducive for them to grow further in coming period, largely because the economy is growing. And we are seeing the retail consumption is also increasing, so the retail credit is also increasing. So from that perspective, I believe that the companies with a pure retail focus are going to be more steady in providing the growth momentum going forward as well. The key would be the re-rating of these stocks. As you rightly observed, I think some of these stocks have been traded at a valuation which is far more lower than the previous past. So from a perspective looking at re-rating, maybe I think the banking sector as a whole, once the rate cut reduction starts, in next 6 quarters or so, we should be seeing most of the bank stocks getting re-rated to the higher levels. So we remain distinctly positive, though selectively in some of the pockets. We add the portfolios, we add the stock into the portfolio as well.
Okay. Hi, Deven. Good morning. Good to see you. And as always, Deven, what do you make of these plays? You know, Swiggy, Zomato, they have come off big time from the top. Swiggy, in fact, yesterday came below its IPO price as well. For those who said that they missed out, the stock ran away, it's giving you another opportunity. Is it an opportunity or would you stay away?
Hi, Nigel. Good morning. Well, I think view remains very clear. As a consumer, I think this particular opportunity remains absolutely formidable because I think you are getting maximum benefit out of the services that these companies are providing. A phenomenal consumer tech platforms that they have built actually. But when it comes to investments, definitely I think the valuations are not supporting the earnings of the company. Earnings of the company, in particular for Swiggy, I think they are yet to come out of losses. They may come out of losses in few quarters from now. That's what the company's commentary says. But in that situation too, I guess I think the valuation-wise, everything is fully priced. Swiggy, Zomato put together, I think will have the market valuation of about 3 lakh crores. And on that, I think the profit, both the companies put together, when you put it together, I think there is not much of something to talk about on the profit side. So in my view, I think these assets are costing, or they are trading expensive in the marketplace at this point of time. Unless I think the market gains some momentum and a fresh money comes for higher amount of risk, I don't think that I think these stocks will be once again getting back into the kind of momentum that we have seen in the past. So I would stay away till the time I think the correction is complete. Maybe time correction would be higher compared to the price correction in given situation.
Okay, all right. Got that. Stay away from them. Deven, I wanted to ask you about a couple of other names from the EMS pack. You have stocks like Keynes and all that have come off 35% in a matter of, I think, 12, 13 sessions. The EMS theme, it ran away, it went up, like a rocket, but it's come down in the similar manner. Your take on these stocks? Anything you like from the pack among all of these players?
So I think the growth point of view, I'm not doubting these companies, but the fact remains that I think even on that growth, the valuations are fully priced in at this point of time as well, despite of the correction in the market price. In my viewpoint, I think unless the risk appetite gets developed further, we are not likely to see the new fresh allocation of money coming into this particular space. Even though the companies would continue to produce better results as they promised, but I don't think that I think on a given valuation too, the immediate follow-up buying will take place. This is part of the price correction. I think some of these companies would enter into some long time time correction actually. Having seen the price correction in the rapid manner, I think the time correction would be at least significantly larger in some of these companies as I see it.
Okay, all right. Thanks a lot, Deven, for stopping by and helping us out with your take on all the stocks that we discussed. Well, let's get to Mitesh Thakkar. He's joining us to help us out with the technical call on the markets. Hi, Mitesh. Good morning. Good to see you in. Good relief rally, Mitesh, we had yesterday, but towards the end, a little bit of a disappointment with the way we closed because we slipped from the top. Your take, is there more in store? Can we extend the up move, say, maybe to around 23,400 or thereabouts, or do you think we'll go ahead and first touch lower levels?
Morning, Nigel. So I think testing lower levels is something which I think, we are kind of looking at it as a diminishing possibility. One main reason is the chart structure set up on the Bank Nifty. The Bank Nifty yesterday opened with gap up, made what can be, called as an early signal of a double bottom formation. If that plays out, then the Bank Nifty should head towards 49,400, 49,800 zones. And once we start getting past those levels, we may even look at a proper reversal in the Bank Nifty. While the Nifty chart is not very encouraging, maybe in a day or two, we'll get a clear signal as to which way we are heading. But at least in the Bank Nifty, it looks like that we have made a temporary low. And in the Nifty also, if we hold 22,800 and then 22,650 zones, I don't think declines could be much below that because we are extremely oversold on the Nifty chart as well. So while it is slightly too early to get optimistic, but certainly there are signs which suggest that, we would have made a low or we might be near a low. In that sense, I think, trading with long bias could be more profitable, especially on the banking and financial names.
Sudarshan, hi, good morning. Are you getting optimistic that perhaps we've made a bottom and think we could be headed higher on the key indices?
Yeah, good morning. See, it's too early to be optimistic in the sense that we have made a bottom. That event happened 2 days ago. It's only possible that after a few days' time, we can give a confirmation that, okay, for the last many days, that low has been held, so we have made a bottom. Today, it's too early. But it is possible to say, at least for the very short term, that there is a trade on the long side. That trade emerged yesterday morning, and that has continued. It's after so many days that the markets did not give up its gains, did not go below the previous lows. So to that extent, as a short-term swing trader, there is a buying opportunity in the Nifty. This is not to say that the decline is over. It is that as we look for 1-2 day trades, the trade today remains on the long side.
Okay, all right. Got that. Trade remains on the long side. And I recall you saying that yesterday as well, and that did work, Sudarshan. You go first. Tell us about individual stocks.
Well, Indigo is a buying opportunity with a stop under 4180. Maruti is a buy with a stop under 11,880. Then we can't forget the banks. State Bank is a buying opportunity with a stop under 746. And an intraday short, they are now, coming in pharma. And that is a sign that perhaps the Nifty is willing to go higher when the defensives start getting a little dull. So Oro Pharma is an intraday short with a stop above 1160. So 3 buys and 1 sell.
Okay, got that. 3 buys and 1 sell. Mitesh, what about you?
Well, I have 3 buys and 1 sell too, and Indigo is on my list as well. Keep a stop below 4240, look for a target of 4355, possibly 4400. JK Cement is a buy with a stop at 4785 for targets of 4950. Also a buy on Axis Bank with a stop at 960 for targets of 1020. And on a mild pullback, sell Sun Pharma, let's say 10-15 points higher from the closing price, around 17.15, 17.20. Sell with a stop at 17.41 for targets of 16.80.
Okay, all right. Mitesh and Sudarshan, thank you very much for that. We'll take a quick commercial break here. We're going to come back with the pre-open session. We'll also connect with the management of Hindustan Zinc to discuss their third quarter numbers. Stay tuned.
Welcome back. In a few minutes from now, we'll get the pre-open rates. But that said, let's get in another management. We have Hindustan Zinc. It reported a rather good set of numbers. Margins came in healthy. Cost of production dipped to a 15-quarter low. To discuss this, what's the way ahead? Mr. Arun Mishra, the CEO and whole-time director of the company, joins us on the show. Hi, Mr. Mishra. Good morning and good to see you again. Well, I recall you mentioned that zinc will be approximately $3,000 per ton in early 2025. So bang on. Good on you. What's the outlook with regard to zinc, as well as silver prices, which have gone through a bit of consolidation?
No, absolutely. I still think the fundamentals are strong. Zinc prices will remain between $28.50 to $29.50 per ton in the fourth quarter. I see the silver prices remaining range-bound between $30 to $31 per troy ounce, and I think these two factors should see us register good numbers. If you look at our 9-month performance, quarter 3 performance, best ever third quarter, 9-month wise, of course, on the volume front, we have grown by about 3% on the volume side, but our overall revenue growth in quarter 3 has been 18%. PAT growth has been 32%, which is phenomenal. 9-month wise, PAT growth has been 28%, which is also one of the best in the market, so to say. So this momentum continues, and $28.50, $2,900 per ton on zinc side, and silver $30-31 per troy ounce should help us to register best ever numbers in quarter 4 as well.
Okay. Sir, are there any signs of slowdown with respect to demand? And what can you guide in terms of a zinc volume growth? When do you think silver volume growth will pick up?
No. So even if we are at 511, so even if we repeat the same performance of quarter 3, we are at 670 plus. So normally quarter 4 is best ever. So I don't see any reason why we should not be touching 700 tons, which can also make us quite good considering the circumstances that in the mines, in the sections where we are working, our grade has not been that good. But at the same time, we will continue our growth in zinc. Our new roaster is coming into place. We have got a lot of debottlenecking has been done, and normally quarter 4 we register the best ever numbers in quarter 4. So yes, while zinc numbers year-on-year basis, we hope to register, 9-month basis 3% growth. It may increase a little bit over 3%. We will register that, and at the same time, silver side we'll try to make up and try to go as close to 700 or cross 700 if possible.
Got it. Mr. Mishra, the bright spot was your cost of production. That's come down to a 15-quarter low. Could you tell us what is the outlook from here on?
So no, it will only be southwards because our renewable power, as we said, is our biggest driver to reduce our cost of power. Our renewable power mix has steadily been increasing. Quarter 4 also will see an exit of more than 13 or 15% of renewable power, which should help us to lower the cost of power and hence the cost of smelting and of course overall cost of finished goods. At the same time, since the volumes are typically best in quarter 4, no more shutdowns, will also show additional cost reduction in quarter 4. So this southwards journey of cost will continue and in the direction of $1,000 per ton as we promised, and we launch further expansion of the mines to achieve finally $1,000 per ton of cost.
Sir, you're generating healthy cash. Should shareholders be expecting any sort of dividend, any sweetener that you're looking at in the form of dividends?
I can't comment on dividend because it's purely on the prerogative of our owners as well as the government nominee directors. They have to decide. As far as my job is concerned, we will keep on producing cash as much as we can and providing a profit of about close to 2,600 or 3,000 crore in a quarter is a good enough money for there. It's up to them to decide how much to give for dividend and how much to give for growth capex and all that. But money is no constraint as far as I am concerned.
Oh, that's good to hear then. But is there an update with regard to listing all the different business verticals separately? Because the street wanted some unlocking of value. Where is that at?
No, so temporarily we have refocused our attention to the two fronts. One, while government was carrying out its wayfares, so we thought we will wait for that, and we saw that. Although the quantities, people might have expected better than that. In the meantime, we focused our attention on critical minerals, and yes, we were participating in auctions. We got selected as a preferred bidder for 4 blocks or so, and one of the tungsten blocks, although cancelled because of other issues between Government of India and local government and all that. But yes, 3 blocks will be there, and we are focusing our entire energy on converting them to composite licenses and quickly explore them, turn them into mining properties, so we can add more metal to our basket in coming 2 to 3 years.
So splitting of businesses, that's taken a bit of a backseat for now?
Not a backseat, I would say. It is waiting for the right time to come out again. We will do that when the situation is right.
Thank you very much, sir, for joining in. That's the word coming in on Hindustan Zinc. Pre-opening rates have settled in, and it's an uptick of close to about 0.3, 0.4% following the Wall Street comeback. Things have opened up in the green. Cipla, Britannia. Keep your eye on Bajaj Auto as well, where there was a margin-led bid. But back to Sudarshan now for his 9:10 call. Sudarshan?
Well, consider buying Maruti with a stop under 11,880. Maruti.
And Maruti reports numbers later today. Mitesh, what about your 9:10 call?
A buy on JK Cements for targets in excess of 4,950.
Okay, all right. Gentlemen, thank you very much. Mitesh, just come back for Stockmo in a bit. But TVS Motor is what we want to revisit right now. Sudarshan is here to tell us more. So, good morning.
Morning, Prashant. So after reporting a strong set of earnings for Q3, when commentary is looking largely positive, company says it will continuously improving EBITDA margin even from the levels of 11.9% that company has reported in Q3. And material costs were flat in Q3, and it will focus on premiumization and product mix. And one interesting comment that company has made is any investment in EV will be based on the consumer feedback, and if there is any opportunity, basically opportunity arises, then only company will be making investment in EV. Brokerages are positive as well. UBS is a buy call, target is rupees 3,100 per share. It says it was a robust quarter with margin expansion despite seasonal weakness. Even outlook is robust with company looking to gain market share in India and even in export segment as well. JP Morgan has an overweight call, target is rupees 3,130 per share. It has raised margin expectations for FY25 as PLI benefits will be coming in the last quarter, that is Q4. So earnings were good, even brokers are positive.
Okay, all right. TVS in focus there, and we'll see what the stock does as we open up in trade. Now, the other one is up 1% or so in at the end of the pre-open session. SBI Card, right? Stock has seen a very sharp sell-off. Can the mood change after the numbers or not really? 4% down in the pre-open. Abhishek is here with more. Abhishek.
Well, for SBI Card, their credit cost was continuous like Maruti had. It's not ever ending for them. So for 24 quarters in a row, their credit cost on a quarterly basis has been above 4.5%. This time it's at 14-quarter high of 9.4% versus 9% in the previous quarter. The net interest margin trajectory continues to remain on the lower side at about 10.6%. So revolver rate has improved to 24% versus 23% in the previous quarter. However, the return ratios are at multi-quarter low with ROA at 2.4% versus 2.7% in the previous quarter. The PAT has also declined massively by 30% YOY and more than 5% sequentially. We have HSBC who has written on SBI Card. They have a reduced call, a target price of about 580 per share. They say that the growth outlook has weakened following the Q3. Asset quality outlook remains unclear too. So they have cut their FY25 estimate by 10.8% and FY26 estimate by 11.2% to reflect the higher credit cost that the company is seeing. Back to you.
All right, Abhishek, thank you very much for that. BHEL is next up on our radar. Vamakshi is here with that one. Vamakshi.
Well, absolutely, Prashant. You know, the company reported its Q3 numbers. When you look at the revenue, that saw an uptick of almost 32% on a year-on-year basis. This is 4% higher than what the street was penciling in. And this revenue growth was supported by better than expected execution in both of their segments, power as well as industry. Now, the gross margin rose by 1,021 basis points to 37%, but the EBITDA margin saw an improvement of only 25 basis points. EBITDA saw an uptick of 41% on a year-on-year basis, but both the EBITDA margin as well as EBITDA came in below the street's expectations, and that is because the other expenses were much higher. They saw a very substantial jump. Net profit has nearly tripled, but again, out here, net profit has come in much below the street's expectations. When we look at the ordering activity, on the other hand, order inflows stood at 6,860 crores. This is an uptick of almost 167% on a year-on-year basis. Even when you look at the order book, it stands at 1.6 lakh odd crores. This is an uptick of 47%. So that part looks very robust. When you look at the segment-wise performance as well, for the power, the revenue grew by almost 32%. EBIT margin as well saw an uptick of 178 basis points to 11.18%. When you look at industry, the revenue saw an uptick of 33% and the margin to improve substantially by 465 basis points. So overall, when we look at the numbers, the revenue has come in higher than estimated, but the EBITDA margin as well as net profit are below estimates, and the ordering activity looks quite robust.
Thank you. CLSA today has lowered the target price to 166 versus 205. They say the stock is expensive at 34 times forward multiple. But it's over to Sudarshan now for Bajaj Auto. Sudarshan.
So for Bajaj Auto, it was a margin-led beat in Q3. Company has reported margin of more than 20% for 6 straight quarters. And so the factors that have worked for the company is the demand continues to remain strong for 125cc plus segment. Company maintains market share in the IC segment despite the expansion that it has been taking for EV segment. EBITDA has grown by 6%, margin has increased to 20.2%. Even outlook is healthy. Company expects export segment to see a growth of 20% plus, and domestic motorcycle segment, for which growth in H1 FY25 was around 6%, but in 9-month FY25 growth was in the range of 6 to 8%. Now company expects this growth range of 6 to 8% to continue for the entire year, that is FY25. So earnings were largely better than estimates, and outlook is healthy for Bajaj Auto.
All right, so thank you very much, and you'll hear from the management, by the way, in 30 minutes or so, less than that actually, 9:30, you'll have the Bajaj Auto management joining us on their numbers. Mitesh is with us. There's 4 minutes to go for the market open as well. I just want to quickly look at the Nifty Bank and where that is closed out at yesterday, because that was the outperformer yesterday as compared to the Nifty. And if you just took a look at the top 10 gainers on the Nifty, 7 out of the top 10 were all banks financials. And there was a long list of broader market sort of financials which did very, very well, about 0.25% higher. And the Nifty will come up as well. And we'll get a quick sense. Mid-cap index is up about 0.19 and small-cap index about 0.33% higher, 70 odd points. So actually in line with what the Nifty is doing right now. Mitesh, price action, you'd largely, if you're looking at, you'd want to buy stuff which is typically making newer highs. But are there any stocks which are turning after the damage, or it's too early yet?
Well, Prashant, as I said earlier as well, I think it is the banking names which are turning. The Bank Nifty itself, I will repeat the double bottom formation on the Bank Nifty chart. We got a closing of 48,041 on the 13th of January. And then we got a closing of 48,064 on 27th, which is Monday. So it's basically 20 points apart, and there are 2 lows being marked. And yesterday we had a gap breakout, and the gap held. So as long as we are not filling the gap, good chance that there's a temporary low or a bottom in place on the Nifty Bank, though we'll get confirmations as we keep crossing smaller averages. The first targets are 49,300, then 49,700, 50,000. But beyond that, I think then we are looking at 52,000 plus levels. So we believe that there are early signs of a bottoming place in the banking index, and then with that you'll have a lot of banking stocks like HDFC Bank, Axis Bank showing early signs of bottoming out. I think that's where I'll start my long trades with, and then eventually if we see this trend is changing on the upside, then you'll have broader markets to trade.
Okay, all right. Thanks a lot for that, Mitesh.
Let's just, sorry, one more question, Nigel, to Mitesh before we thank him. Mitesh, just a quick word on a couple of more names. PB Fintech, if you can just take a look at the charts. High flyers come off quite sharply recently. And then a couple of more. PB Fintech first.
So, Prashant, if you look at the history, somewhere in September, October of 24, we saw multiple lows being made around the level of 1600. And then we got a closing of 1610 on Wednesday. And since then, we haven't broken that. So, if there can be some base building, some rest of the decline around these levels, then I think we might see a reversal happen. But for me, it's important that the level of 1600 holds, and then we see some kind of possibility on the upside. Also, it's important to note that the 200 average is at 1613. So there is multiple support, historical, weekly consolidation. There's a 200 average. I think as long as 1600 holds, in the next few days, you will see some kind of reversal on the upside.
Okay, all right. Thanks very much, Mitesh. But there's so many names, right? But typically, when you look at technicals, you want to buy stuff which is not breaking down, which is turning, or unless, of course, there are, as Mitesh said, a double bottom for the Nifty Bank and maybe some signs of a recovery starting to emerge. But otherwise it's been largely down and lower, and some intraday recoveries. Actually not some, lots of intraday recoveries in mid and small caps yesterday that we saw. What do we have? First rates, so it's going to be about 1/3% higher. It is 0.36, 23,040. The Nifty Bank is about 49,000, a little over 49,000, about 0.15 higher. You've got the mid-cap index up about 1/4%. Mid-cap index was down 1/4% by close yesterday. Actually, I should say only down 1/4% because at one point it was down almost 1.8%. And then the small-cap index will come up as well to give you a quick sense of where we are starting. That is up as well. That ended about 1.7, 1.8 lower after being down 4. So about a quarter. Feeble kind of recovery, but it's green 16,000 and 38 on the small-cap space. About 2:1 advanced decline, but stocks are still opening up. Nifty heat map is up on your screen. There's more up than down, and some green. Actually lots of green this morning. So let's see if it holds 23.35 with about an 80-odd point gain, guys.
Well, Bajaj Auto is your top Nifty gainer, up 2%. There's lots to like in the numbers, as Sudarshan was pointing out. It was a margin-led beat. And analysts also like the export story. The company is guiding for exports to grow at 20% for the next few months, while the industry overall, domestic, should grow at 6 to 8%. Even the EV portfolio is turning out quite well. So Bajaj Auto is your top gainer, 2.5% up. Cipla continues with its rebound from yesterday. Post numbers yesterday, Cipla was higher, margins look good, and Cipla has added on another 2%. Tech is leading the rebound today following Nasdaq's recovery. So Infosys, Wipro, Tech Mahindra, all three gaining close to about 1.5%. TCS follows with a 0.5% up move. So IT is on the front foot today after the losses over the last, earlier this week. Other gainers include BEL, Adani Enterprises, Apollo Hospitals. But again, the gains there are limited to about 0.5%. On the way down, you've got BPCL that's taken a knock, that's down nearly 2%. HDFC Life is subdued, JSW Steel is weak. And keep your eye out on ITC. As we said, ITC Hotels list today. It makes its debut on Dalal Street. ITC for now is flat with a positive buys. And Maruti and Tata Motors are two stocks to watch because they report their numbers later.
Well, that's right, Rima. Just to pull out a few stocks, that are bouncing back. Sidma, SGS, that's up close to 9%. So that's very, very good news. And up close to around 9% as we speak. CG Power, that's bounced up close to around 5.5%. We'll speak to the management in just a short while from now. Suzlon saw a sharp correction from the top. For the time being, it's bounced back. Anant Raj, they put out a clarification now with regard to their exposure to data centers. So that as well is up close to around 5%. I'm looking at some of the losers. JM Financial is down close to around 8%. So I'm not sure what's gone on there. Numbers. All right. So that's taken a hard knock. 8.5% lower. Apar Industry is one of those big gainers in the last few years. Well, it's gone up more than 10 times, I think, in the last 4 years. Yesterday, it was down 20%. Today, as well, it's down close to around 4%. So let's see whether or not there is any kind of interest that comes at lower levels. Piramal Pharma numbers didn't look too bad, but the stock is down close to around 2.5% as we speak. So for the time being, the markets are in the green. The breadth of the market, if we can end anywhere close to this, 3 stocks advancing with 1 stock that's declining, the bulls will feel very, very good. And it's been a while since they felt so good. But the good part is we still have stocks like Sirma that are bouncing back, now up 10%. Wow. When did we see that last?
Absolutely. NetWeb is recovering about 7-odd%. One-way fall, right? The bottom of the screen. And actually, one of the sharpest falls has been in NetWeb. but coming up with about a 200,000 share volume right now, 1565. And that is related to sort of, data center hardware and a bunch of businesses which are related and feeding into that sort of AI-led infra build-out. Now, the other, of course, as Nigel mentioned, is Anantraj. Both, by the way, have put out clarifications this morning about the fact that DeepSeek is not going to sort of hurt them. If anything, it expands the market. And with Anantraj, of course, it was the data center build-out and, that was propelling the stock higher. Valuations aside, I mean, they're saying that, well, it should not hurt. So that's Anantraj for you. But otherwise, I mean, I think it's largely up and about with a fair bit happening at this point in time. So slowly, the mid-cap index has crept up to about being 0.5 higher. The small-cap index is up about 0.65. We've got about a 100-odd point gain there as well.
Just these capital market-related plays, the cyclicality is now showing up. So JM Financial is one where the net profits declined by 22%, but even Motilal Oswal is down 3.5%, reacting to the Q2 numbers. Again, profits are down nearly 14-15%, and that stock is under pressure. So whether it's the brokerages or the wealth managers or depositories, I think this quarter has been a bit of a check for these capital market players, which have had a one-way run over the last couple of days. So keep your eye on that. Today, these are the two earnings, JM Financial and Motilal Oswal. VIP, keep your eye on that because competition is really hurting VIP. And this quarter, VIP has reported a loss and the stock is down nearly 4%. On the way up, it's Ixigo or Late Travenues Tech, where the numbers are looking good and the stock has gained nearly about 4.5%. And BHEL, that, Vamakshi was just telling us about how the top line looked good, the order book is robust. Brokerages are betting on it, 4% up on BHEL.
Well, I just want to pull up the intraday chart of a few stocks. You pull up JSW Energy, the stock was down 10%. They've seen some kind of a recovery from the day's low, maybe some shots in the system as well that could have played a role. But that's up close to 7% from the low point of the day. That chart's telling you the picture. Pyramid Farmers, the other one, that as well was down. That as well has seen a bit of a recovery. And SBI Cards as well, I think it started off 5% down. That's cut its losses a little bit. So at lower levels, some of these stocks seeing some kind of support. So let's see how that goes. But the Nifty Bank, that's the one that needs to drive home the advantage. For the time being, it's up close to around 50 points. It's doing a relative underperformance in the first few minutes of trade. That needs to drive the Nifty higher if at all we need to go past.
TVS Motors, a stock that Sudarshan was just telling us now is one to watch because in the conference call, the company spoke about improving margins. TVS Motors, straight off the back, early trade, 7% up on TVS Motors. So that's clearly the star in today's trade in the auto pack.
No, absolutely. And I think as, for the broader market, maybe, if you're typically in mid-caps and small caps correct very fast. And if you're not out within the first 5%, 10%, then you kind of wait. Yeah. That's the normal human kind of, psychologically it is very difficult. So as they say, right, if you panic early.
Yeah.
Otherwise, don't panic. Because now I think it's even as so. The point is that maybe the selling pressure we've had that may be starting to abate. Whether stocks will rebound with the same ferocity is another question.
Yes.
Broadly speaking.
Yeah, and another point, Prashant, is some of these stocks that are seeing that incremental, from 20% falling 30%, it's because of trading action. May not be so much related to the fundamentals because there could be a large holder in there who's stuck in some other position, and that's why there is some liquidation. So in the near term, some of these companies which could have come to those attractive levels, they are actually reacting to the trading action rather than the fundamentals. So we'll have to keep an eye out on that part as well. And sometimes, selectively, some of these provide great entry opportunities. So we'll have to see how that goes. For well-run companies with trading at decent valuations and in fact promising growth. And promising growth as well.
Absolutely. Let's put some of this stuff to Vikash Kumar Jain, right? India's strategist and head of research at CLSA, who is joining us now. Vikash, great to have you with us here. Thank you very much for your time. I mean, I think the big one came from the RBI day before yesterday with regards to their liquidity enhancement measures. First up, how important is that for the market? And do you see that as a precursor to rate cuts? Are those expectations firmly entrenched in the market now? Go on.
See, the rate cut part, honestly, is not that easy a guess because there are other elements to it as well. We need to appreciate the fact that liquidity before this move was very, very tight in many years, one of the tightest in many years. And we're getting into a period where there is a bigger liquidity demand in the system because of taxes, etc., as we draw to the end of the fiscal year. And this could very well have been because of that itself. Does this mean that we will have a rate cut? That's the bit which is not so straightforward, in my opinion, because there are other elements like the way rupee is depreciating and the uncertainty on the dollar with whatever's happening with the new regime in the US. So I'm not sure if I can be so confident of a rate of this being a hint to a rate cut.
Interesting, Vikas, and good to see you in as always. Well, tell us, what's your overall view on the financials? How will they potentially be the beneficiary of the RBI's move and potentially rate cuts that we're looking forward to? Who benefits the most, banks or NBFCs?
If liquidity improving along with, we anyways have an opinion that sometime later in the year there could be rate cut possibilities. I'm just trying to debate whether it is immediately or not. All of that in general will be more beneficial for wholesale funded, financials. So it will be more positive for NBFCs. It will be more positive for banks with lesser CASA dependence. So that's the kind of, stocks that would benefit more at the margin from this particular action and from future rate cuts that might happen.
Vikash, what about the broader markets? We've seen the small cap index, mid cap index pretty much enter into the bear territory. It's been a fall of more than 20% from its highs. The screen is looking a lot better today, but do you think the pain is over or there is more of a correction to go?
See, there are a few things over here. Markets in general, we've been quite worried on mid caps for a few months. Maybe we were a little early, but I think if you look at relative valuations on mid caps and the fact that there is some uncertainty around near-term economic growth in terms of, maybe that we are experiencing a slowdown, and with those sky-high valuations, typically they would be far more vulnerable. On a relative basis, we clearly have a preference towards large cap over mid caps and small caps. So large caps is clearly our preferred area. In fact, I would say our preferred area is mega caps. If you were to look at our India-focused portfolio, we are quite overweight mega caps. I mean, a lot of stocks which are over $40 billion market cap over there. So that's the part in terms of preference within the capitalization. However, on markets in general, we've reached a very interesting point where fundamentally we were seeing that this overvalued period could cause a correction. That corrections happened. We kind of were worried about it right at the start of October, and that's kind of played over the last 4 months. We are down even on Nifty 12-13% or so. Yes. Now, interestingly, our proprietary gauge called the sentiment gauge, which tries to quantify sentiment, called the India Bull Bear Index, has recently hit extreme bearish sentiment. In fact, this is the sometime one of the days last week when we saw it, and maybe it will be there somewhere this week as well. Sentiment as measured by this gauge was the weakest since the COVID lows. Okay, so that is a very interesting point. Typically, it has a good track record in kind of, whenever sentiment goes to an extreme, to say that now we could have a contra move. This could be a contra move up. The bit that is more dicey is whether this will be, whether this is the end of the correction or whether this is just a rally and a recovery where sentiment normalizes, we have another leg down. But for now, I would want to, for the ones who are kind of short on the market, this is something where one needs to kind of bear in mind that sentiment has gone to a pretty extreme level as per our proprietary benchmark, which has traditionally been very good in predicting the extreme points in the market.
Okay, all right. How has the market, Vikas, reacted once it sort of hits those extreme sentiment levels which you mentioned? And I remember we've in the past also spoken about whenever we've hit peaks and extremes and what is followed next in that sense, near term.
So what we do not know about this sentiment gauge is, see, it just tells you that sentiment is at an extreme. It cannot foretell how will sentiment normalize. Sentiment can normalize by, volatility coming down, lack of activity and range-bound action. In extreme cases, that's a rare situation. Typically, it has a spike on the other direction, and then sentiment normalizes. And after that, once it is not at an extreme, the index is not that useful. It can very well happen that sentiment goes to well above, close to neutral with a 5-7% rally. And then after that, it can again come back. So that's the bit which it cannot foretell. Historically, it has led to reasonable corrections. Like even as recent as November mid, we had a sentiment pullback. And from then we had a 7% rally in the following 10 trading sessions or so. So that's something which can very well also happen, even if this is not the final bottom. So that's something that one should kind of bear in mind. It just tells you it's at an extreme. How the sentiment will normalize, we will only come to know as the future plays out.
All right, Vikas, you spoke about mega caps. We know you added Reliance recently. So in mega caps, which are the safe havens in general?
So we've not added that stock recently. There were a few other stocks that we added at the start of the month. That stock has been there for some time in the portfolio. But within, in general, for the portfolio, which is a large India-focused portfolio, it has only 10 to 15 large and liquid stocks. I mean, nothing which trades less than $10-15 million will ever be part of the portfolio. It's a very large and liquid portfolio. We went into an out of consensus overweight on staples right at the start of this month, and an out of consensus underweight, a big underweight on industrials again. So those were the two big calls that we took. Other than that, IT and healthcare are our other underweights. While banks is a small overweight, commodities is the other overweight that we have in the portfolio.
Okay, all right. Now, what's the view on the IT services sector, Vikas, post all these reports around the Chinese AI startup DeepSeek and how it kind of threatens the US dominance in artificial intelligence and large US mega caps? I mean, any implications for IT services here?
See, I think there are pushes and pulls for IT. This DeepSeek event is simply just telling you the vulnerability of stocks when they are at very high valuations. So, I think that's when they are at valuations which are tough to explain. We were overweight on IT till October, and then we turned underweight. In fact, within IT, the name that we own is the most defensive of the lot. So I would say that I'm just not comfortable in looking at IT, and I believe we've already had a pre-Trump trade into IT after November, December, the way the sector did well. We are towards the fag end of that trade, in my opinion. That's why we are underweight on that sector. And our preferred defensive is not IT, but staples.
Well, thank you very much for that, Vikas. You have been calling out for consumption to lead the rally, and that being your preferred play. Thank you very much for joining in. By the way, look at the broader markets and the recovery now. The mid-cap index is up more than 1%. The small-cap index has raced away to a 1.5% rally in the first 15 minutes of trade, and the advanced decline ratio is looking quite healthy. We've got 9 stocks advancing for 2 stocks currently declining. But let's get to Bajaj Auto. The management is waiting by. The stock is doing well because earnings were better than what the street was anticipating. Margins above 20% for the 6th straight quarter. We have with us Rakesh Sharma, Executive Director at Bajaj Auto, now joining in. Thank you very much for joining in. This is Rima here. That's the first question, right, on margins. Can you sustain margins above 20%? What led to the margin performance in the current quarter? And even your EV portfolio has turned EBITDA positive. Where does it go from here?
Hi, good morning. Yes, the story for the quarter was coming in at 5th straight quarter of 20.2% EBITDA margin. And it's really driven by a combination of very judicious pricing being taken across the portfolio at regular intervals, as well as, the supportive softening of the rupee, which happened at a very good time from our point of view because of the expansion of the exports business in the quarter, where after almost 9 quarters, exports crossed 500,000 units or $500 million in terms of dollars. So, but there were forces which were downside forces, like, the mix changing a little bit because of the drop in exports to KTM, which were almost higher, which are higher priced. The rise of the Africa component of the business. But, all this put together, we were able to dynamically manage the margin architecture and deliver 20.2. Going forward, I think with the, as you mentioned, one of the best things which has happened towards the closing part of last quarter, and particularly now we will experience it, is the launch of a new platform in our electric business. And mind you, the electric business now is about 22% of our domestic revenues, so quite substantial. But that business now moves into the green zone because of work done by our procurement and R&D teams. We have been able to slash the costs in the electric business, and that moves into a green zone. The commodity basket, there are pluses and minuses, but overall the commodity basket is looking pretty stable. And with exports also looking like clocking the same tempo of growth, with the rupee at about realizations, in fact, improving further in Q4. We think that we have got a sound line of sight to maintaining our margins.
Okay, all right. Hi, Mr. Sharma. Good morning and good to see you again. So exports will grow at 20% or?
Yeah, they have been, like we've been saying, that they've been year-on-year basis growing. At last quarter was 27% growth, and on the back of recovery in almost every region, led by, of course, as I've been saying, in LATAM. We think, and with our good positions in some of these key markets which are coming back to the growth story, I think we should be able to maintain this 20%. But we are watchful of the macroeconomic situation and the geopolitics of it, because a lot of the emerging markets, as you know, are quite vulnerable to any changes on that front. But for the moment, yes, we are planning for a 20% plus growth next quarter.
All right,
let's in Q4.
Let's come back home then. On the domestic front, the festive season demand seems to have got sustained. I think earlier you were guiding for around 6 to 8% growth in terms of the domestic industry. Do you think, going by the current data points, you could be maybe at the higher end, 8% could be assumed, or do you think it'll be closer to around 6%? I think the first half of the year, the growth was around 6%. How is demand trends on ground, basically?
Yeah, you're right. The first half, the motorcycle industry was clocking something like 6% growth. And it's really the 36-day festive period which saw a massive upside, going up to almost 16% growth during that period, which has lifted the year-to-date growth rates to about 8%. To project any growth rates, it's better to not get distracted by temporary shifts, but to take a slightly longer short view of things. And when we see year-to-date growing at about 8%, we feel that yes, 6 to 8% growth should be achievable by the motorcycle industry in financial year 25. But let me also remind you that that is almost similar to what the industry achieved in FY24. So we would say, yeah, 6 to 8% is what should unfold.
You spoke about headwinds in the form of KTM exports, and I think there was a 50% drop in KTM exports. When do you expect this issue to get resolved?
Well, the management of KTM AG is busy putting together a restructuring of the debt plan, supervised by the court, as you know. And there is quite a definitive timeline for that, which is 25th of February. By then, that is when the plan will be presented to the administering officer as well as the other stakeholders. And once that plan is accepted, I think things will start to get to normal, and hopefully the business can start getting restored in the subsequent quarters. The brand and the product acceptance and the demand continues. What needs to be done by the management there is to get the debt restructuring right and have enough liquidity.
And 25th Feb is when the plan will be presented by the KTM management. So while exports are seeing good momentum and you're confident that that will sustain, so 20% plus in Q4 as well, Nigeria's sales at 35,000 is still below your historical highs. When do you think you will be able to recoup that and get back to those levels?
You know, India business, the Indian industry has still not recouped its way back to 18, 19. So I don't know how useful these benchmarks are because, yeah, it was 50,000 maybe 3 years ago. What we are looking at is quarter on quarter improvement. Yes, there is a potential in Nigeria, and we're very happy with the way the business improved. We have got a 55% market share there. So it's a very important market for us. But as you know, the currency is fragile. The situation has to be monitored month after month, and we are just taking it month and quarter by quarter.
Okay, all right. Let's talk about the other opportunities then, Mr. Sharma. And as you said, EVs as a percentage of domestic revenues, it's improved to around 22%. I recall first quarter was 14%, then 20%, then 22%. So good on you on that front. The other big opportunity could be e-rigs. Could you tell us about the launch out there? What kind of market opportunity does it look at, and which cities would you target? Because, you know, brokerages are quite positive about this launch and they believe there's tremendous potential. So spell it out for us.
Yeah, you're absolutely right. You see, what is this whole e-rig business has in the last 2-3 years almost crept up on the industry because of various reasons. And today, if I just look at the three-wheeled industry, three-wheeled rickshaws, not differentiating between autos and e-rigs, that's almost 100,000, and out of which about 45,000 per month is e-rigs. Now, a lot of these e-rigs are lead acid powered, which is, you know, something which is not good for the customer or the industry or the environment, and those are being phased out. And the lithium ion based e-rigs have started to enter. So we are talking about, you know, 45,000 units per month. They serve a particular use case. You know, they're narrower. There is their speeds are limited. Their seating, because of the structure, the seating is extra, and they particularly serve the customers in smaller towns and dense areas. And we are taking a aim at this market, building on the tremendous franchise which we enjoy with the customers and drivers and fleet owners with our Bajaj Auto RE business. So by end of March or early April, we will be presenting the Bajaj Auto's e-rig to the market. Mostly this business is in the north and east, with parts of west, and we'll be taking an aim at organizing this sector, because a lot of it is very fragmented with substandard products, and we hope that we will be able to delight both the passengers and the owners with this presentation. We will have a product which is far more stable, which is able to go up, gradients far more successfully. Right. It has more durability and will have a much superior powertrain, and the drivability will be far smoother.
Just a quick follow-up on this. So you're saying the e-rigs market opportunity or the size today is 45,000 units per month. Yeah. What are you hoping to achieve, by the end of, say, 1 year post-launch? Do you have a number in mind? And secondly, your margins. Quickly, sir.
No, we don't have a number in mind as yet. Our first thing, as is always, is to present the product and ensure that it gets accepted, and watch out for, observe how it is getting accepted before we start scaling up. We have not yet come to the pricing discussions, even within our company. And as we come closer to the launch date, we will finalize the margins and obviously the pricing.
Thank you very much, Mr. Sharma, for joining in. Always a pleasure chatting with you. Look forward to the next. For now, it's time for a break. On the other side, Amar Kaul of CG Power and Industrial Solutions will get chatting with us.
Welcome back. CG Power is the next management that we are speaking with. Stock's doing well. It's up about 6.5 odd percent. It got beaten very, very hard from the highs of about 800. Yesterday at one point was down to about, I think closed at about 574 after making even a lower low. I think 520 was the low yesterday. So it's a full 100 rupee recovery for CG Power coming in from that level. Third quarter numbers maybe slightly mixed, you can call it. But I think the focus firmly for CG remains on what they'll be able to do in FY26. Amar Kaul is Managing Director and CEO at CG Power. He's joining us to take those questions. Amar, good morning. Good to have you back on the program. Thank you very much for joining us. Let me go in reverse a little bit. Let me start with the outlook and then come back to individual segments and what's happening, because there's a lot to cover there as well. Especially because what we've seen in markets, many are focused on companies like yours, good promoters and stable kind of business. And of course, in all the right segments in that sense in the industrial space. So give us a sense, Amar, of what kind of growth you're looking at, both in terms of top line and margins for FY26.
So thanks, Prashant, for having me. As usual, enjoy the conversation. So, yes, the quarter has been good, and of course, not giving into the forward-looking how it looks like, but we are bullish about the opportunities that we have within the country as well as outside the country. And that's what we are actually riding on to make sure that we control what we can instead of worrying about, macroeconomic trends.
What does that mean, though? Will in FY25, fiscal FY25, what should we look at in terms of, say net profits? I have got some estimates here, but help us understand. And then FY26 as well.
So we'll keep improvising. As I said, we don't give forward-looking guidance on that. But if you remember last quarter when we spoke, I told you we'll bounce back because I was not worried about one-odd investments that we did. So we are almost there where I committed that we will be. And moving forward, important is, as I said, controlling what we can control is what we are looking at. So I think we'll definitely we'll continue to grow. And you have seen even different segments. If I go a little deeper into our industrial segment, power sector, even the market overall, the numbers don't look very good, but we are still able to grow in industrial sector as well, which has not been doing so well. Which means the market is still there. You just need to go and get your piece of the pie.
Got that. Talking about industrials, the street, Amar, is a bit disappointed by the margin performance in the industrial segments. Now, you're saying this is on account of a greater skew towards railways. So what percentage of your industrials business came from railways this quarter? What can you guide going ahead on the margin front? And you wanted to get to 15% margins on a consolidated basis. When do you think you'll be able to achieve that?
So, yes, two questions. One, of course, we don't give the full percentage of what railways is and what motors is. But what I can say is our commitment to the nation building for Indian Railways. We'll keep supporting Indian Railways more and more. Railways business is growing much faster, high double digits. Having said that, our motors business, out of which industrial portion, for a change for last 3-4 quarters, if you see it was going down. And this last quarter, we are actually positive, both on the profits as well as on the top line. So which is a positive sign that the market is available and we'll continue to get into that. So the skew may change a little bit here and there. And of course, as we are doing our go-to-market strategy to balance Indian Railways with the exports as well, to make sure over the period of next few quarters, we are able to take it close to 14 to 15% PBT that we have a commitment to. So we'll keep inching towards that direction.
Okay, all right. Hi, Amar. Good morning and good to see you, Ben. You're putting up, I think, capex of close to around 700 crores for the power transformers capacity. I think is likely to add close to around 45,000 units or thereabouts. Help us out with understanding a couple of details out here. What would the asset turn be and how do you fund this?
Yes, see, it's a combination. So two things. One, this facility that we need is basis the power demand that you have in the country as well as for exports. Today, if you see our order backlog is almost for next 18 months, we are done with that. And we still see inquiries floating around. So it's a great opportunity for nation building as well as for exports. So that's why this investment will go in. Location, etc. We are in the process of hopefully in the next 30 days or so, we should be finalized where we're going to make this investment in. That's number one. Number two is also in terms of funding. One, of course, there are a combination of internal accruals. And of course, as you know, for QIP, we at some point will be raising more funds to make sure we have the surplus cash available whenever we have these opportunities of investment, whether it's expansion or any of the potential acquisition.
Okay, got that. The other one where you can provide us with some detail is this the OSAT business which you're setting up. Is everything on track? When will this be commissioned?
So yeah, absolutely, Prashant. That's on track. So OSAT, we had it two phases. One is the mini factory and the main factory. So the mini factory work is already in progress. It is 100% on track. FY26 is when the production will start there, and that's going on that. And FY27 will be when the main factory, the big factory, will start also. So machines, equipment getting ordered, the management team is in place, the operators, 2 engineers, they are getting trained in the global factories of semiconductors so that they get hands-on experience the moment we start. So the complete project is in control.
You have tie-ups in place for technology, etc.?
Yeah. So I think we had a joint venture with primarily Renesas and Star.
Right.
And so we are using that combination, so working together on that.
I got that. So 26 is the smaller one, and the big full thing comes up on stream in F527.
That's right.
And in terms of the overall sort of revenue opportunity from there, as we get closer to commissioning, do you have a better sense of what that could be?
I think hopefully probably in one or two quarters we'll have a better sense of that, but it's as per the plan, and I'm sure you would have picked up from we shook hands with the government as well, central government, for partnering together, so we get the support from the government as well. So yes, we'll have a better sense in next 1 or 2 quarters.
What about inorganic growth? Should we hear something from you before the end of this fiscal? That's when you join us next for your Q4 numbers. You're on the lookout, so I ask you.
So that's always ongoing inorganic. So the pipeline of candidates that you can potentially look at, of course, it's not just go around and shop. So it has to have the right fit and complement to what we are doing around the work that we are doing. So I would not commit that next fiscal or something, but yes, when it comes, you'll be the first ones to know about it.
Yeah, we are looking forward to that, and hopefully the fit is right, for you. So we'll wait by for that. But always a pleasure talking to you, Amar. Thanks a lot for joining in, giving us a sense about how demand is panning out and how you see the business shaping up as well. Let's focus on the other company, that's Suzlon. Reported actually a strong set of numbers. The revenues have zoomed by close to 91%. Margins came in healthy as well. The company expects the wind industry constraints around land acquisitions to improve starting from FY26, which will be good to hear. Well, let's understand more. Mr. Himanshu Modi, the Chief Financial Officer at Suzlon, joins us. Hi, Himanshu. Good morning. Good to see you win. The street clearly likes your numbers. After a while, I'm seeing the stock is up close to around 5%. Let's address a couple of issues. Execution was good in the past quarter. Do you expect execution in Q4 to be 25% better than what we saw in Q3? Could that be a possibility? And also, if you could help us out with margins. You told us it will improve. It has improved. Does it have scope to further improve in Q4? Execution and margins. Please go ahead.
So execution, there are two ways to look at it. Clearly from the deliveries manufacturing front, I think we will continue the growth trajectory, certainly from Q3 to Q4 as well. On-ground execution is where, not only Suzlon, but as an industry, there are certain challenges which we are looking at ironing out. So from an execution where what we call commissioning of the turbines, which is whether land issues or power evacuation issues, that is taking a little more time than we anticipated. But I think clearly no red flags there. It is just about being a little patient. It's on the right track for commissioning as well, whilst deliveries will continue to grow. So far as margins are concerned, I don't think we will see a growth from Q3 to Q4. But I think directionally, as we are getting economies of scale and volumes of our manufacturing is kicking in, we are seeing better margins kicking in and getting the leverage for us from a negotiation perspective.
Okay, all right. On the execution parameter, you did around 450 megawatts in quarter 3. So quarter 4 could be better than that, 20-25% better. So we end the year then closer to around 1.5, 1.6, right?
So again, I won't give numbers, but yes, traditionally...
My numbers are not very off, Himanshu. My numbers are not very off.
I know you guys. I know you guys. So don't worry, Q4, all I will say is Q4 will be better than Q3. Don't want to be putting a number of 20%, 25%, but certainly Q4 will be better than Q3.
And Himanshu, morning. In terms of the order book as such, the overall execution was about 5.5 gigawatts. What is the execution timeline for this?
So the 5.5 gigawatts is about 18 to 24 months is the execution timeline. In this quarter, as you know, we've also ramped up our manufacturing capacity. So we can do about 4.5 gigawatts annually from a manufacturing perspective. Of course, the execution on ground has to match with the manufacturing capability that whether it's us or even the industry is able to do. But the current order book that we have needs to be executed over a period of 2 years. Of course, as we move along, there is also an active pipeline of orders that we are negotiating or bidding for. So we'll only keep adding to this order book as we keep delivering quarter on quarter.
You're expanding capacity though as well, right? Some capex you're doing. But even as you're saying, there is a bit of a mismatch between current capacity and execution on ground?
Yes, certainly from a manufacturing capacity vis-a-vis execution on ground, there is a mismatch which will take some time to catch up. So, until about 6 months back, our manufacturing capacity was restricted to about a little over 3 to 3.5 gigawatts. We've now expanded that to 4.5 gigawatts. Our new plant in Pondicherry has now been commissioned. Our new blade molds that we've ordered have been commissioned. So as we enter the new fiscal FY26, we will be entering with a full rated capacity of about 4.5 gigawatts per year from a manufacturing perspective. And our growth capex will continue. So there, we've given guidance always that close to about 300 to 400 crores a year for the next 2 to 3 years has been earmarked as capex for growing the capacities.
Himanshu, so just to get it right, you're saying that Q4 margins should not be directionally higher than Q3. So Q4 margins similar to Q3 levels, or will it be lower? And again, getting back, because I remember in one of your earlier conversations in this year, you had spoken about a 1.6 gigawatts execution target for FY25. Does that hold?
So on the margin front between Q3 and Q4, I think, it will be fairly similar. As and when you must appreciate that as and when the projects activity or the EPC activity picks up, which is a lower margin business, it does have an impact on the blended margin. So, I don't see too much of a difference between Q3 and Q4 margins as we move along. So far as annual capacity on what we can deliver, we've done 977 so far. And across all parameters in the 9 months of this financial year, we've already exceeded what we did for the full year in FY24. So as I said, Q4 will be better than Q3, which means it will certainly be higher than 447. Now, where we land up with that number, of course, time will tell when we reconvene sometime in May.
Just one more word. So far, what we've heard from Donald Trump is sort of anti-renewables. Does that hurt the sentiment surrounding your business while you are covered for the next 18 to 24 months, given your order intake and the order book and the visibility that you have for the next 2 years? But what are your clients, global customers, talking about the renewable demand going forward?
So I think, we of course all heard the commentary that's coming from the US, from President Trump. All I like to say is that in his first term, and that is data available, renewable energy both in India and US have significantly grown. So we haven't read the details on what the executive order states, but so far I don't see any impact on that, at least in the Indian market. The bilateral ties between the two countries, as we've read various media reports yesterday, continue to be strong. So I really don't see that there would be any impact to the renewable industry on the whole, at least from an Indian geography perspective.
I don't know why. That those comments, right? He said, Trump said, I don't want solar farms, I don't want wind farms, and what that was about. But I think we'll let us see action more than talk, which we've seen a fair bit of. Himanshu, in terms of more acquisitions, more coming, I think you've indicated in the call.
So, we of course did one acquisition in, Q2, September earlier this year, which was, or last year rather, which was of Renom, which was in the multi-brand O&M business. So whilst, like any other company, we are very selectively on the lookout. We do have appetite for acquisition within the space, but we'll at the same time be very selective about it. I don't see anything in the annual, in the immediate future translating into an acquisition, but we are keeping our eyes and ears open. But again, to be sure, nothing in the immediate future.
All right, Himanshu, the street seems to be worried a little bit about execution, about the valuations. The 78,000 crore market capitalization, even post the correction. And I think your quarter four is normally the best in terms of profitability. So you should end the year closer to around, I think, 1,300, 1,400 crores of net profit. Going by the execution, going by the kind of tailwinds, and the issues will get resolved, do you think in the next 3 years or so, you could deliver a net profit, say, which is closer to around 4,000 crores on upwards of that next 3 years, going by the execution pipeline? Should that be a possibility?
So again, I don't want to comment on 4,000 crores and 2 years, 3 years outlook. I mean, there are more than half a dozen analyst reports out there, which now directionally give certain numbers about the company. All I would say is that, like we did about 700 megawatts last year in the FY24, we've already done 977, and we have a healthy quarter still ahead of us. We have a 5.5 gigawatt order book, which needs to be executed over a 2-year period. So, of course, I'm sure if you have access to those analyst reports, I'm quoting from those analyst reports. Those analyst reports for FY26 peg the net profits at anywhere between 2,000 to 2,500 crores, depending on which one you pick up for FY26. Directionally, how that moves for the next 2 to 3 years would also depend a lot on the policymakers and the industry, how it shapes up. But if the trend continues, then I think from a Suzlon perspective, whether it's a management team, order book, ability to manufacture and deliver, we are in a ready position to capture that opportunity.
So for next year, at least, you think the analysts are pretty much in line, because the longer term, let's not talk about. But for FY26, even I'm looking at those reports, 2,500 crores or thereabouts, that's achievable. That's the aspiration, right?
Let's talk about that, Nigel, in May when we again convene. But looks like striking distance.
I tried, and I think I pushed you a little bit. But and I think your indication is your indication is that mostly that's in line. We appreciate you joining in, Himanshu. Wishing you all the best. Looking forward to chatting up with you. And as you said, some of those issues you see, they're getting ironed out, and the pipeline looks good. 700 megawatt last year. This year it should be double of that, and maybe the following year it'll be even better. For the time being, slip into a short break. On the other side, Manisha Gupta is waiting for us to tell us what's going on in the commodity space.
Okay, welcome back. 100 plus points on the Nifty. So holding on for now, 23,061 is where we're at. Mitesh is with us with what he'd like you to do. He's, of course, been calling for a pullback and a reversal in bank Nifty and banking sector. Mitesh, what are you observing and new trades?
Morning, Prashant. Till now, I think it's the Nifty which is, beating or outperforming the bank Nifty. But I think the chart structure for both the indices now suggests a possibility of a short-term low. The Nifty, I think, from extremely oversold levels is for the first time on the 30-minute charts, hourly chart is trying to make a higher high and higher low kind of formation, which should see at least a short-term reversal, if not a medium-term one. So the idea is a trade on the long side. On the stock specific basis, I have a buy on IRB Infra, which I would recommend buying the stop at about levels of 50.3 and a target of around 55 to about 56 on the upside. And the second stock is IRCTC. Again, this could be an early indication of possibly double bottom on the 2-hour chart. So here, recommend a stop at about 745 and a target of around 785.
Thank you very much for that. One more stock, Keynes Technology. There is a Jefferies upgrade on the stock, and they note that the stock has fallen 38% in the last 1 month. So after that kind of an underperformance, Jefferies has upgraded Keynes Tech to a buy, 9% up on that. But it's over now to Manisha for a complete check on commodities and what the one commodity that she's tracking very closely today.
Well, thank you for that. I'm looking at metals as a space. You know, if you look at this year, we started on a stronger note with markets anticipating that the Chinese data is coming in strong, and you could be looking at demand improving. But the last few sessions, we've seen prices pull down strongly. And currently, we are looking at very strong arbitrage opportunities. And that is because many of the metal prices are strong in the US and have seen a decline on London Metal Exchange and various Asian countries as well. The reason that you have seen the prices run up in US is because there's a lot of stocking happening, even hoarding for that matter, ahead of the expected tariffs coming in. So US has threatened to impose tariffs on copper, aluminum and steel imports. And we've seen prices of all of these commodities and metals gain up in the US markets there. So higher domestic production is what the US is talking about within the country. This will mean higher manufacturing cost for the US consumers there. But this would also mean global demand continue to dampen on the lower side. And that's exactly what we've seen in prices. So the US metal prices are higher, but the rest of the world is looking at weaker prices. The expectation from the market also is that the value-added specialty metal products perhaps may not be taxed because there's no immediate substitute for that. So what we really are looking at is raw and smelted and refined metals in that space. I want to talk about copper right now, and this is very interesting because when you look at the copper prices on LME, we have been constantly declining, but the US markets have been on the higher side. So the kind of premium that the US copper is right now commanding is $389 a ton. Strong markets there, and importantly, US imports nearly 38% of its copper requirements. So this is exactly what will be getting taxed or tariffed. Talk about aluminum, and nearly 82% of its annual consumption in sense of aluminum is what US imports. And this majorly comes in from Canada and Mexico, more from Canada rather than Mexico. And that would mean that if tariffs come in, then we are looking at higher prices here as well. So like copper for aluminum as well, when you look at the US premium, it's trading at $530 a ton. This also covers, by the way, taxes and logistics as well. I quickly want to take you on what we've done in the first 1 month of 2025 in sense of many of these metals. So while gold and silver, your safe haven commodities have continued to gain up, more than 5% of gains coming in for both of these. But the rest of the base metal packs clearly has been quite mixed. I actually want to show you on what copper prices have done on LME and the US markets there. So for the US markets, we are up by 5.5% for copper, but for London Metal Exchange, we are up by 4%. So you can see that premium there. For aluminum prices, it has been quite flat, and zinc, which gained up by 14% last year, is down 8% already. The market's clearly waiting out for guidance that the US Fed meeting will bring in tomorrow.
Okay, all right, Manisha, thank you very much for that. Commodities there in focus. Well, ITC hotels have started to trade now. 179 basically is where the quote is coming in as at this point in time. Mangalam is here with some details on this demerged entity. Mangalam, over to you.
Good morning. So, if you look at the price, the quoted price at around 180, it's absolutely in line with the analyst estimates of the fair value of the company. Analyst expectations basis, the company's performance in the past, the multiples that they ascribe to it, and the fundamental valuation was a range between 175 to 190 odd rupees. But, at the open itself, the stock was optically lower to the implied value from X date. Why is that? Because on the X date, which was Jan 6th, the stock opened about 26 rupees lower versus the previous close, and the underlying assumption was that the entire 26 rupees was attributed to the value of the hotel business itself. That's not the case. The hotel business valued anywhere between 17 to 19 rupees per share, and at 180 rupees, the stock is trading around 27 times FY26 EV to EBITDA multiple, and that is pretty much in line with the street expectations because, in terms of the pecking order, the street values ITC Hotel somewhere between Indian Hotels and Chalet Hotels. Indian Hotels trades at around 37 times, Chalet Hotels around 25 times. So between 26 to 28 is what the fundamental multiple of ITC Hotels should be. Now that the company is listed, we'll talk about the fundamentals post the company reports its numbers. Importantly, from a technical standpoint, just keep an eye out on passive flows because as per Nuvama's quant research report, the company is likely to meet criteria for inclusion in the MSCI Global Small Cap Indices. And remember, now that ITC Hotels is listed, it's part of the Nifty. For the next 3 days, it'll be part of the Nifty. Thereafter, it'll be excluded from the Nifty. And when that happens, there would be a passive outflow of close to around $100 million on Nifty exclusion and around $65 million on sensex exclusion. All of that happens on T+3, which is 3 trading sessions from now itself. So we'll keep an eye out on ITC hotels at that time.
Okay, all right. Mangalam, thank you very much for that. So that's ITC Hotels, the new new kid on the block, if I can call it that. Well, it's our special segment, Budget Countdown, and they'll come up after a break. Lata will be speaking with Mr. K.B. Kachru of Hotels Association of India and Vijay Devan of APJ Surendra Park Hotels on the sector's ask from the Union Budget on Saturday. Stay tuned.